Welcome to Inside Scoop with Sean Emery. Every week we are examining something new, bringing you closer to companies, sectors, and themes. This recording should not be construed as a substitute for personalized individual advice from Avery & Company or any guest on the show. This is for educational purposes only and not intended to make an offer or solicitation for any companies or securities mentioned. With that, let's get on with the episode. Alrighty, welcome to Inside Scoop. We have Seth Golden, the Chief Market Strategist from Phenon Group. We had him on previously. I'm Sean Emery, the founder and CIO of Avery & Company. We run a high conviction equity strategy. I want to welcome, obviously, you, Seth, and welcome back. It's an interesting time to bring you on. Obviously, you and I collaborate offline plenty. We share charts, collaborate on some of our thoughts. I think last time we spoke was maybe October. I believe that was the time. It was either a month before or a month after.
Peak inflation fear.
Yeah, exactly. I think knock on wood, our belief that inflation was subsiding and was going to subside even more, specifically in some of those month over month numbers, some of those year over year numbers, all across the board. Again, CPI gets the headline, but PCE is out there, and PPI is out there as well. We saw what that was this week. Throw on everything else, some more fairy dust on, Silicon Valley Bank and Credit Suisse and all the nuances that are happening there, the yield curve and such. So what I wanted to do today was, first give you a chance for the individuals that haven't listened to you previously. You're a big follow on Twitter, but also, you run the Phenom Group. So just tell us a little bit about that so we can get into the mix.
Yeah, appreciate it. Thank you for bringing me on again. We started Phenom Group in Christmas Eve of, the day after Christmas on 2017. And it's a boutique macro market research firm. We help to educate investors, traders of all walks of life, whether you're a novice, intermediate, consider yourself an expert, maybe you're running your own fund. So every week we do macro market research reports as well as videos, everything from technical analysis, fundamental analysis, and quantitative analysis. We have high conviction strategies related to volatility trading and just general long-term investing, trading philosophy, strategies to keep investors engaged, keep them in the market. The only way to win is to stay in the market long-term. We're not one of those, get in and out, try to time things, as I often try to educate investors that, the best strategy, time-tested, as well as rate of return, is buy and hold, only followed by dollar cost averaging, and then just scheduled allocations. And at the very bottom of the list is market timing. So that's what we do at Phenom Group. I specialize also privately. I do a lot of consulting for hedge funds and within the consumer packaged goods space. So your companies like I don't know, you name it, Pepsi, Coca-Cola, Keurig Green Mountain, Dr. Pepper, Nestle, Kellogg's, General Mills. I've had engagements with all of these consumer packaged goods companies over the years, and retailers like Target, Walmart, Best Buy, Macy's. I used to do a lot of sell-side analytic works on the retail and consumer packaged goods space. I'm of the opinion, if you're going to be a good investor, you have to have an understanding of the economy as well as just the consumer. The 75% of our GDP is consumption. If you know the consumer, you'll probably do well as an investor.
There you go. Yeah, no. So, we're going to go in kind of, a windy road here, just given the environment. And I think, there's a couple areas that are just super important to touch on at a very high level. The state of the macro, that can be dissected into so many ways. Mm-hmm. It includes inflation. It includes, what the Fed could or could not do or say or hint at. How we've been thinking about, slightly around, some of the challenges out there. We have at least to us, the famous wheel of death, which is, the supply chain issues that started essentially then volatile demand, which, everything from, goods to services back to, potentially goods, and see what happens with services, to other inflation dynamics, whether it's food and whatnot. Then last year we ran into the Russia-Ukraine issue, which just exacerbated some of the issues that were out there, specifically around commodities. And then ultimately that feeds into what is the Fed going to do and where we are in the Fed raising cycle, hiking cycle, and when that will end. So everybody knows what the cost of capital is going forward. And, business can get back to business, like we like to say. So, let's dissect some of those in general? I think, give us your level, the state of the macro, broadly
Yeah,
speaking, and, some of the dynamics around inflation.
sure. And forgive me if I get long-winded.
Yeah,
The
no
way
problem. I'll
that
cut you off.
the way that I've envisioned things playing out into the end of last year and here in the early part of this year is that we would avoid a recession through year end 2022. Q1 had the better chance, just from a technical standpoint, to generate a recession because we were simply lapping high comparisons from last year. So you can get a technical rate of change issue in all manners of GDP and metrics. Having said that, I don't think a lot of people anticipated the acceleration that we saw coming into the new year. Just a lot of economic activity that seemingly was spirited from some late 2022 pent up demand. There was a lot of layoffs going on in the fourth quarter of last year, and that seemed to provide this headwind for consumer spending, personal consumption. And then when people realize, oh, by the way, I still have a job, I still have a paycheck here in the new year, I might as well go about my life. There's still not yet a recession, and there's still, nearly 11 million job openings. So that's 1.9 job openings for every unemployed person. If there was a market to rent out jobs, I mean, line me up, because that's a lot of available jobs that are currently vacant. So with the dynamics that we have so far as the corporate balance sheets and the household balance sheets, as well as what's going on in the labor market, tight as it may be, you have these cushions underlying the economies should any kind of economic strife, or some kind of blow hit the economy. To your point earlier, SVB, right? That's going to, the SVB collapse. Now First Republic, and then yesterday you get some more sprinkling of the Credit Suisse situation. And these are the headlines are pervasive. Households see them in their nightly news, and they think to themselves, "Wait a second, do I need to move my money somewhere? Do I need to leave this bank and go to another bank?" Well, within that consideration, there's generally also some pullback in demand. They want to see the most consumers, most households will want to see those headlines dissipate before they go out and start spending again. And usually that's a good couple weeks. So I look at the high frequency data to give me more of a real time understanding of what the sentiment is out there in consumer land. Johnson's Red Book comes out every single week. It's a broad sample of U.S. national retail sales. So that's going to be my go-to. It comes out every Tuesday, and that'll give me a good idea of the impact from some of these recent headlines, as well as the overall pullback in the markets. I mean, we lost everything. We were up a good almost 10% in the S&P 500 at the peak this year, and we literally gave up everything. So you put that all in the blender, and we really need to see how the average household continues or pulls back on their spending, and that'll give us a good purview into the resiliency going forward of the consumer. Because I know a lot of the investment banks, a lot of investment houses out there, Goldman Sachs this morning decided that they were going to raise their recession probability to 35% from 25%. Mind you, they lowered it to 25% in January. So here we are in March, and they're back to 35%. It just goes to show you, if anybody's trying to forecast the near-term outlook for the economy, let alone the market, I mean, that's just a dangerous game to play. We're kind of in this uncertain period where, is the Fed or isn't the Fed? Are they going to pause? Are they going to go 50 basis points, 25 basis points? In speaking to that element, I guess you could say it's a little bit of a gift, for some easing of the hawkishness in this rate hike cycle. Going into these SVB situation and the Credit Suisse and First Republic, as well as the recent inflationary data. Everybody was looking at 50 basis points. The CME Fed Watch tool, 50 basis points had the highest probability for next Wednesday's FOMC meeting, 50 basis point rate hike. Within a week, we were talking about, with all of these different events occurring, no rate hike was actually at one point in time yesterday the highest probability. And now it's back to being 25 basis points. But I don't think anybody is anticipating a 50 basis point at this stage now, with only 1 week to go. And it's really going to get interesting. The day before, whatever the Fed fund futures are pricing a 60% probability or better. So it's either a pause has the 60% probability, meaning no rate hike, or 25% has a 60% probability. Whichever one it is, that is what's going to happen on Fed Day. Historically, that's never been wrong. So we'll see how that goes down. I think they're going to do 25 basis points simply because they want to get this last one out there. And the ECB, European Central Bank, they did 50 basis points today, in spite of the fact that there are these Credit Suisse issues out there. My outlook is that the consumer is resilient. Inflation is coming down continuously. We are 9 months straight of CPI down, PPI down. We are more than 3 percentage points in CPI being lower, telling us that Fed or no Fed, inflation's coming down. The PPI had a negative month over month print, telling us that that's a leading indicator of CPI. The cover is there. All the cover is there for the Fed to, if they desire to do a 25 basis point hike and signal that they're willing to pause, they can do that. If they don't want to risk the financial stability of the system, they can also pause at the next meeting and not do any rate hikes. I'm just not too confident in one way or the other which they're going to do at this point. I let Fed fund futures be my guide the morning before.
Yeah, and a lot can change, right? Just given the fact that we have the Credit Suisse still out there,
Right.
we have the lingering commotion around all that. I'm just reiterating some of the stuff. So I have this chart here, which basically shows core PC or CPI using real time real estate data and what the current would be if you use like Apartment List and Zillow and some of the
Right.
others.
Right.
And then also using it on a 6 month annualized, you get a core rate of on a 6 month annualized at 2.1%, while the actual number, using the kind of stated data that's inside the release is 5.1. So there's a big mismatch between those two.
Right.
Obviously, some of the other stuff are lagged as well. You could say used car prices actually ticked higher and didn't reflect that. But this is such a big component of the overall index that it matters more. And it's one of the reasons why they got it wrong the first time to begin with,
Right.
which is using this type of information. So that's interesting. I wanted to bring up also that a tweet that you had around liquidity per household.
Right.
And I think that what you're trying to infer here is essentially the buffer that's potentially sitting there inside of households. So if you just wanted to share some data, this is on your Twitter, but share some data on it.
Correct. Yeah, I mean, the average household, you break it down by decile. That's what's done here in this chart. The top 20 decile, the middle, the 60 to 80, and then all the way down to the lower 20% decile. The cash balances are still well above where we were pre-pandemic. So 2019, cash balances, no matter whether it's high income, middle income, lower income, the cash balances are still very strong. And this was from Morgan Stanley, but we also have data from Bank of America research that came out earlier this month that pretty much shows the same thing, whereby retail sales, card spending data for Bank of America clients. So people say, well, why Bank of America? It's because they have the largest number of depositors in the United States. So their card data tracking is obviously going to be the majority of consumers. And so all of this shows that, heaven forbid, we should run into a situation in the economy where, we start losing jobs, which is still probably a ways off. The average household has, ample amount of savings cushion, as well. Their leverage is very strong. They have liquid assets. Their homes are very liquid at this point, mainly because we're back to record low inventory in terms of listings on the market. And while that's happening, you also have this dynamic where we have mortgage rates that are probably going to come back down a good 50 basis points within the next week or so, reflecting what's going on in the treasury market. And so we might run into the situation again where we have multiple bids on houses and people are bidding above the asking price. And that's all predicated upon, if indeed those mortgage rates come down enough. But either way you slice it, the consumer is just in really good shape. Everybody's been calling for, consumption pullback. Retail sales have been down on a month over month basis, 5 of the last 8 months. And there's, again, just been some anomalies around this data from a seasonal perspective, how the data is gathered from November to December of last year. And then we had this breakout January retail sales print of 3%. Well, there's no way you're going to jump over that on a month to month basis. That is one of the highest prints you're going to see outside of a pandemic. So naturally, the month over month was down for the month of February. But overall, you have retail sales growing at almost 6% annualized, still in the third year post the pandemic. Historically, you've never had a recession when you're growing retail sales at a 6% annualized clip. Last year, we were growing them 8.5%. I said the same thing. Anything above 6%, you've never had a recession that year.
Sure. I mean, I'm bringing it up here, but the Fed tracker, which tracks GDP, ironically, yesterday hits the highest level it's been tracking all quarter, and a lot of that is due to consumption, which I think is stated to grow at roughly 4-5%. And these are real terms, which is interesting as you start to back out and think about adjusting for inflation,
Right.
Based off spend. You see some of, let's say, the department stores or some of the areas within the consumer that like for like basis year over year are maybe struggling. But the reality is a lot of that is they pulled some demand forward maybe a year and a half ago.
Yeah.
They're lapping many of those. Some of them are trying to be prudent in terms of not bringing on too much inventory, so restricting the amount of inventory, therefore could hit sales. But you're then seeing Delta came out and I believe last week or this week and basically highlighted how they're seeing their best 30-day revenue ever. And I find that to be frankly pretty interesting. So the consumption's just shifting more broadly speaking. Pushing into some other areas, and I'll just quickly share some stuff from yesterday, which was again what I do most of the time is listen to earnings reports, right? And that's kind of like my day to day, to be quite honest, and analyzing these businesses. And a very up to date point of view of the world is you have a $20 billion revenue run rate business in Adobe that essentially touches all marketing professionals and creators.
Beat on bottom, beat on top, and raise guidance.
Exactly. And then you have UiPath, which, is, call it, an important tool within, automating tasks inside of corporations. They're very much at the enterprise level. And, they came out with a pretty strong guide for the full year, basically, reiterating the plan they laid out late last year. So you have, these two companies real time. I mean, they had everything out there to say, let's be a little bit more conservative here. That's as real time as it gets. Visa spoke yesterday as well. Visa said they're not seeing any, disruption in their payments in terms of where people are spending money. PayPal said the same thing. I think, I tweeted out that
Morgan Stanley Investor Conference, PayPal said that they were seeing of what they expected, consumer discretionary spending on their platform. Transactions, the transaction volume was above where they had anticipated coming into the year.
Yeah. So again, those are just, we get the data, the hard data. We get, the soft data in terms of survey. And I know you have a nice opinion on that. But then also, you have some of the, the mosaic of these companies that are pretty important, just talking about. Now, what's important as well for like the fundamentals of, call it, the economy, but for the companies is that, last time we spoke, that was in October, and even before that, 6 months, 12 months before that, everyone was saying recession. And, I just showed the Fed nowcast growing at, 3 and change for the quarter. And obviously, things have changed in the world slightly here from a credit growth perspective and possibly some other things. But, a lot of these companies are prepared, which is why you're seeing earning estimates start to creep back up for many of these companies. So, if we shift from, macro, like very high level, let's talk a little bit more about, inflation.
Mhm.
your point of view on inflation. Obviously, we had some data, but looking a little bit more forward again, um, and looking out 6 months, what's your views on inflation going out?
Yeah, I've long since said that the disinflationary process would be known to have been cemented by the fourth quarter of last year. And in my view, and based on all the data that we've seen, the disinflationary process is, further cemented. Now, within that, 30,000 foot view is the understanding that disinflation isn't a straight line down. You get these hiccups, and a lot of that is just because of the dynamics in consumer spending as well as supply lines. Still, they're so much better than they were last year, and they're still improving, but we still have some hiccups, some starts and stops, so to speak, within the supply lines, and hesitancy and ordering patterns. A lot of this is due to retailers went shock, and we're talking about the biggest retailers in the world when you talk about the likes of Walmart, Target, Costco around the globe, where their ordering cycles are still not in tune with a typical economic cycle, expansion cycle. So from one quarter to the next, they're still trying to offload last season's inventory, which is inhibiting next season's ordering cycle. And typically, these retailers will order out 6 months. That goes with their advertising spending as well. And the reason why I add up is because that's impacting online, advertisers, advertising dollars, the likes of Meta, Google on YouTube, etc. Even Amazon now, who's disclosing their advertising revenues. So, I would say I do believe that the disinflation cycle is going to continue. A lot of folks are still. There's this narrative that the Fed is worried about a 1970s style, start stop into the early 1980s kind of inflation. I don't look at it the same way. We didn't have the technological advances in the 1970s, early 80s that we do today to solve these problems in a more efficient way. And that's everything from wage inflation right down to services and goods inflation items. So, I'm looking for something with a three handle by the end of this year. And I think a lot of times these narratives overshadow the fact that, by the way, we are about to lap some extremely high comps on a year over year basis when it comes to CPI and PPI. All of that before you get those critical, most heavily weighted components of CPI, like shelter owner's equivalent rent. I'm of the opinion I thought we'd see it by March, and now I'm less confident that we'll see it seep into the March CPI data. But by Q2 is the average historical lag time in those shelter owners equivalent rent data. So when that kind of stuff hits the CPI, the narratives can change extremely fast. I think a lot of folks are holding on to recency bias. They're holding on to a narrative about inflation absent the potential impact of that shelter owner's equivalent rent data. All else considered equal, we're not really, like, if you push forward, if you do a 3 month push forward on both CPI and PPI, they're historically the average, anywhere from 0.3 to 0.2% on a month over month basis. We've not done much more than that on any singular month since the June peak.
Right.
And when you annualize that, you're barely at zero on an annualized basis for CPI. And I've also long since said everything past the June rate hike, the Fed has been over tightening. And that's why I use the 3 month push forward data, because it shows you on an annualized basis, if you just keep printing those 0.2s and 0.3s, you get to zero. You get to unchanged on an annualized basis. So why is the Fed tightening?
Yeah,
Right.
no,
So,
that's
so that's
important.
where I come down on these things.
Yeah, that's important, and I think what's important as well is the notion that you also don't want to have like material deflation, right? So you actually
Right.
don't want to have that 1 month where you get a whatever 1.5% decline month over month in price. Typically, that is seen bad, specifically when you have an economy where people are concerned about debt. You
Right.
don't want to deflate while your
Right.
debt is
Exactly.
rising.
Exactly.
You rather
It's
have
just
the
as
opposite.
uncomfortable
Yeah,
as elevated. Deflation is just as uncomfortable as elevated inflation.
exactly. Yeah, yeah. Talking about more, investment valuations again. I'll articulate it again at the beginning, but it's these aren't recommendations for purchase or sale of any securities. But in general, if you look at the valuations of the market, there's so many ways to slice and dice them. You could look at the caps and say small cap trading
Mhm.
in the low teens range. You could look at the XFANG, and that's trading in the mid to just below teens range. You
Right.
can take the FANG by itself and say that's trading in the low 20s range. Um, how would you characterize the value of, broadly speaking, the markets? And then we can narrow in slightly.
Um, and this is out of consensus. I'm generally viewed as out of consensus when it comes to valuation because my trading style and or philosophy is when I get a cheaper price, I should be buying a cheaper price. If that opportunity is presented, you know, I want to jump on that opportunity. So I rely less on valuation as a component of my, general investing exercises. Having said that, I do believe that the equity markets will just look at the S&P 500. I believe it's undervalued. And the reason why I say that, I think you had touched on earnings a little bit ago, is I think that the earnings estimates came down too late, right? Too late in the cycle last year, and I believe that they came down too far. To your point earlier, let me get my charger. Sorry. To your point earlier, Adobe and a host of other companies. When we look at the 3 month forward percent positivity earnings change for S&P 500 companies, basically guidance for Q1. Okay, to keep it simple, basically guidance for Q1 has inflected higher by a significant amount. We now have more companies that have positively guided for the first quarter than we have in the last 3 quarters. So the analysts caught down too quickly with their earnings estimates. And now I believe that based on what we're hearing out of S&P 500 companies and what they're forecasting, this earning recession that has been the drumbeat of late 2022 into this year may not materialize. In fact, if we don't fall into a recession, more than likely, all the cost cutting activities, all the expenditure cuts, capex or otherwise, that we've seen from these large cap companies that contribute mostly to the S&P 500 earnings, will actually still, even in a lesser revenue environment, they'll be able to earn more. So when I look at the valuation, I say, at let's call it 17 times forward 12 months, that's fair value. Why is it fair value? Because when we talk about valuation, it's comparing generally to the bond market, right? And the 10-year for today's video is at 3.5%. And oh my gosh, it was what, a week ago, over
I like how
4%.
you say today's. Right
I
now at
had to, right?
3:30,
Yeah.
which is pretty interesting. I actually have some interesting news to bring up here that's real time that just broke on my Bloomberg terminal. But um,
Go
it's
ahead.
let's see this thing. So we got basically all the big banks putting deposits into First Republic to shore up. So they're giving 5 billion from a couple of them. So it looks like Bank of America, J.P. Morgan, Wells Fargo all putting a 5. Goldman Sachs, Morgan Stanley putting 2.5 each, so another 5 there, and then a series of others essentially putting a billion each. $30 billion getting thrown into First Republic. I
Right.
believe what did they have? Possibly 150. Probably
Deposit.
give or take. So adding 20% deposit buffer here. It sounds like. I don't think them doing that is a giveaway per se, but it's more again. There's so many ways to maybe think about this, but I do think it's interesting because that is the flavor of the week this
Right.
week, and
Right.
likely
Yeah.
going to impact next week as well.
Yeah. It's why, a lot of these pessimistic and cynical narratives, the outlook 2023 contingent on things that at best stay the same and at worst get worse. When generally that's not how it works, right? Where there's a will, there's a way. Just saw the way. We saw the way with the Swiss National Bank stepping in overnight, to shore up Credit Suisse. And we saw the Fed and combined again take care of the situation with SVB Bank. So that's why I look at these narratives about the S&P 500 going to 3,200, blah blah blah. I'm like, okay, things have to. You need to get that from here. You need human to fail. You need folks to decide, we're just not going to solve the problems in the pre-election year for the first time since 1981. Never had a down year in the market on a total return basis year since 1931. You have a lot against you if you're looking down right now. But back, what is the historic correlation between the 10-year yield and the S&P 100 PE with the 10 3.5 to 4.5%? And it's 8 to 19 times.
Got it. Yeah, no, that makes a lot of sense. I lost you there a little bit, but I think we got the gist of a little bit or most of that. And you repeated the valuation framework there. Yeah, we had the same thought or philosophy, I guess, going into the year was, around, taking the average yields in certain timeframes and what the multiples tend to look like. And, again, I think when we frame it, when we look at everything and we step back, and I think that's ultimately what you have to do. You have to start at the macro and the micro as well. And, at a very high level, it's a simple, conversation where, you're trying to look at all the different players that make up the economy that drive, future growth. You have, the consumer, you have housing, biggest asset, biggest liability. The consumer remains fairly resilient. Again, this isn't like, the robust consumer of 2020, but that also shouldn't be the yardstick.
Right.
And, the normalization of the economy, I think, is such an important concept that people have to recognize. And, soft landing, hard landing, recession, non-recession, I think the best path forward is essentially a slower path.
Yeah, I agree.
And get everything slow and normal.
Right.
So you don't have gyrations in demand and gyrations
Right.
in price and gyrations in Fed talk. And, we can all kind of get to our normal steady state and make our assessments based off of, a flatlined economy. You could argue the market will do probably better in a zero growth world.
Yeah.
Because the market is like this stair step of, sharks eating sharks and growing their valuation on top of each other. And the market doesn't always reflect like the economy to the T. Because, some of the companies are, more important to the economy, and the ones that are more important are generally creating more value and therefore taking up more value in these indices. And, you see the chart out there, the famous chart, right? Which is, market cap to GDP.
The Warren Buffett indicator.
Yeah, it was the Warren Buffett indicator.
Right,
I can't imagine he uses that too much. I think he bought Occidental like today.
I know. Again, more and more. I came into this year, and I forgive me for interrupting.
No
problem. One of my calls last year, because I don't make a lot of broad calls. But I should say one of the suggestions at Phenom Group was to stay away from energy. While energy had a 40% plus earnings growth for the sector, that automatically sets a high bar. But the biggest issue was all of the shares those energy companies had been issuing since 2020. So you run into this structural overhead supply that becomes just an impossibility. So that was my biggest call, late last year was just, look, you get your 1 year in this commodities boom. Everybody always talks about, it's a commodities boom. It's a commodities boom. We're going to have this commodities boom cycle.
Super cycle.
Yeah, I'm like, these commodities booms generally last less than a year in the modern era. And that goes back to our earlier conversation of, people are anchored to this fear about a 70s style inflation spiral. But ever since the technology era, we've had such great disinflation due to the advances in technology. Why would you think human ingenuity would actually revert and not be able to solve these problems in that much expeditious fashion? So that's kind of my take there.
Cool. Yeah, look, a couple more minutes here and we'll wrap. I think we covered a lot. and just having like an open discussion about it all. The last thing is really, we've talked about it a little bit, but getting the Fed out of the way, I
Yeah,
think, is the most important factor of all of this.
I
And again,
agree.
it's
Yeah.
really people just understanding the cost of capital. And I think you've seen that, right? So like going from, 0.5%, 1% to, 4.5, is 90% of the way through. Even if you assume, even go to like 5.5%, right? So
Mhm.
it's the concept of understanding, a lot of the, parabolic move in terms of, shock to the system has happened. And we talk about lags, but, the bond market was well before, Fed funds. So the most important thing is the Fed conversation next week. So there's the concept of the dovish pause, or the dovish hike, and
Right.
the hawkish pause.
Right.
I know you said you just let the data tell you, right? And
Yeah.
we'll see that. But let's say if they did hike
Mhm.
by 25 basis points, do you expect a dovish tone from the Fed, or do you expect something a little bit more what we've been hearing in the past couple
Yeah.
weeks?
Yeah, I think the best setup for the Fed, right? If we're talking about credibility, and if indeed the Fed is worried about their credibility, which I think that's just a narrative in and of itself, um, I think the ideal play here would be for them to hike 25 basis points, speak dovishly to all they have to. I mean, Jerome Powell says the word pause or look around. The phrasing of an understanding that they're going to wait and look around before they make another decision, definitely, I think the markets will favor that. We're going to see the disinflationary benefits in liquidity in M2 when it does update here for this quarter already. And then you throw on I think maybe also, Sean, is any language around QT. I think any language around what, is there going to be a disruption of QT, or maybe they dial it back? That will also be seen as dovish. So they actually do have a couple of avenues where they can hike and yet still appear dovish, going forward. For which I think all manners of market participants would take that as a bullish outlook. The data is there. This PPI and CPI data has made it, given them the cover to do so, to pause. But you could say the ECB gave them the cover to do as you said, a dovish hike.
Yep, cool.
So
Seth Golden, everyone. Appreciate you, coming on and
thank you again,
chatting
Sean.
again. I think just to conclude it, it sounds
Mhm.
like you know, generally speaking, valuations are fairly attractive if you use a model of the multiple to average rates, and just adjusting for that. And I agree with that myself. The consumer, pretty good shape. And a lot of that again has to do with Bank of America credit card data, or deposit data. um, Real-time wages actually starting to increase here in the last 4 6
Yes.
months.
Yeah.
You have the Fed, and ultimately where this comes to is the Fed essentially out of the way. And I think a lot of the recent stuff that it's occurred has likely accelerated that pause. Yet we, from our conversation back in October to today, much more the same in terms of the views of inflation. It's not a straight line. It's I mean, if you draw from October to today, it's
Does
fairly
look
straight.
like it. Yeah.
It's fairly straight, but there's wiggles in between.
Mhm.
And expecting more of that into the future as real estate data feeds into it. Some of the food data will start to lap here the commodity boom of Ukraine,
Yeah.
Russia.
Yeah.
You'll start to see some of that stuff, oil, energy. Anyways, but with that, I'll let you go. Where can they find more about Phenom Group? I obviously had some of. If you're watching this, we had the Twitters of both of us,
Mhm.
and you can go to those if you want a lot of the research that we post out there. But in general, to find more
Yeah.
about Phenom Group.
Yeah, just you can visit us at phenomgroup.com, phenomgroup.com. We also have a YouTube channel, Phenom Group YouTube channel. If you're
Nice.
interested in broad market macro research, I say macro market research because we all of our works hold the three disciplines: technical analysis, fundamental analysis, and quantitative analysis. So, Sean, I think you actually articulated the three-legged bar stool of the bullish tilt going forward. By the way, so
Cool. Well,
thank you.
hopefully, either one, I see you in Central Florida here shortly,
Yeah.
Or two, we talk, in another 6 months.
Sounds good.
We
Thank
want
you
to see
again,
where we're
John.
at. Awesome, Seth. Have a good one, man.